There is a secret hidden in plain sight, a philosophy of wealth so potent, yet so profoundly boring, that 99% of investors walk right past it. They are drawn to the bright lights, the deafening noise of the new, the next, the revolutionary. They chase rockets to the moon, hoping to catch a ride on a trail of fire and hype. And while they are looking up at the sky, Warren Buffett is looking down at the ground, at the steel pipes and copper wires buried beneath their feet. He is looking at the quiet humming transformers on suburban streets, and the colossal, silent dams holding back entire rivers. In this kingdom of the mundane, in the world of regulated utilities and essential infrastructure, he has found something far more valuable than a lottery ticket. He has found a promise, a near certainty. He has found a government-guaranteed license to print money, slowly, methodically, and relentlessly, for decades on end. This is not a story about getting rich quick. It's a story about getting rich for sure. It's about trading the thrill of the gamble for the quiet satisfaction of the inevitable. It's about understanding the final promise that these boring businesses make, a promise of stability in a world of chaos, a promise of predictable growth in a market obsessed with speculation, and the promise of a financial future built not on hope, but on the bedrock of human need. We begin our journey in the final days of the 20th century, a time of profound financial delusion. The year is 1999. The world is mesmerized by the dot-com bubble. It was a mania of historic proportions. Companies with no profits, no tangible assets, and often no coherent business plan were being valued in the billions of dollars. The simple act of adding .com to a company's name could send its stock price soaring into the stratosphere. Financial news networks were a constant parade of 20-something founders in T-shirts, promising to disrupt and paradigm shift entire industries. The old rules of value investing, of caring about things like earnings and balance sheets, were openly mocked as relics of a bygone era. This time, the chorus sang, it's different. Amid this frenzy, in his quiet office in Omaha, Nebraska, Warren Buffett was doing what he always does. He was reading. He wasn't reading analyst reports on the latest internet IPO. He was reading the annual reports of companies that did things like generate electricity and transport natural gas. And in the fall of 1999, he and his partner Charlie Munger found something that was the polar opposite of a dot-com darling. They found Mid-American Energy Holdings Company, a modest utility based in Des Moines, Iowa. To the rest of the market, Mid-American was invisible. It was a boring, slow-growing utility in a flyover state. It provided electricity to farmers and townspeople. It was predictable. It was stable. It was everything the market at that moment despised. But to Buffett and Munger, it was beautiful. They saw a fortress. They saw a business model so durable and so protected that it was almost unfair. Mid-American operated as a regulated monopoly. It had no competition. If you lived in its service territory, you bought your electricity from them, period. The government didn't just allow this, it enforced it, in exchange for regulating the prices the company could charge. On October 25, 1999, Berkshire Hathaway announced it would acquire Mid-American Energy for approximately $2 billion, a deal that included taking on a significant amount of debt. The market barely blinked. The deal was a footnote on the back pages of the financial press, which was busy splashing headlines about the latest multi-billion-dollar IPO of a company that sold pet food online. Buffett was buying tangible assets, power plants, transmission lines, pipelines that had been serving communities for decades. The market was buying promises and pixels. Buffett was buying a business that had a legally sanctioned moat around it, a fortress of certainty. The government, through the Iowa Utilities Board, effectively guaranteed that Mid-American could earn a fair and stable return on the capital it invested. It was a contract with society. You provide a reliable, essential service. You invest prudently to maintain and upgrade your systems. And we, the government, will allow you to earn a reasonable profit. For Buffett, who had spent a lifetime searching for businesses with durable competitive advantages, this was the ultimate moat. It wasn't a brand name that could fade, or a patent that could expire, or a technological edge that could be leapfrogged. It was a moat protected by the force of law. As the deal closed in early 2000, the world was about to change. The dot-com bubble, inflated by cheap money and pure fantasy, began to hiss air. Then it popped. Over the next 2 years, the Nasdaq index would fall by nearly 80%. Trillions of dollars of speculative wealth vanished. The new paradigm was revealed to be the same old speculative mania. And in Omaha, Buffett's boring utility just kept humming along. The farmers in Iowa still needed to power their irrigation systems. The families in Des Moines still needed to turn on their lights. The business of Mid-American energy was utterly disconnected from the speculative frenzy of Silicon Valley. It was a bastion of reality in a sea of illusion. This single transaction was the seed that would grow into one of the largest and most important pillars of the entire Berkshire Hathaway empire, a division now known as Berkshire Hathaway Energy. It was a foundational move, a testament to an idea that is more important today than ever. In a world obsessed with unpredictable upside, the most powerful financial advantage is the elimination of catastrophic downside. The greatest strength is not excitement, but certainty. At the very core of our brain, in a small, almond-shaped cluster of neurons called the amygdala, lies the epicenter of our financial decisions. This is our fear and threat detection center. When we face uncertainty, the amygdala lights up, flooding our system with cortisol and adrenaline, preparing us for fight or flight. The stock market, with its flashing red and green numbers and its constant stream of unpredictable news, is a playground for the amygdala. It's what makes us panic sell at the bottom and greedily buy at the top. The entire principle of Buffett's love for regulated utilities is a masterclass in managing this primal, irrational part of our brain. He has found an asset class that essentially tranquilizes the amygdala, allowing the prefrontal cortex, the seat of rational long-term thought, to remain in control. This is achieved by exploiting a powerful cognitive bias known as ambiguity aversion. Research by behavioral economists has shown, time and again, that humans have a profound preference for known risks over unknown risks. We would rather take a bet with a 50% chance of winning $100 than a bet where the odds are ambiguous and unknown, even if the ambiguous bet might be mathematically superior. A regulated utility is the ultimate known risk investment. Its business model strips away almost all of the ambiguity that plagues other companies. Consider a typical technology startup. Will its product find a market? Will a competitor build a better version? Will the founding team be able to execute? Will their entire industry be made obsolete by a new invention? These are all profound ambiguities, unknown unknowns. Investing in such a company is an exercise in navigating a fog of uncertainty. Your amygdala is on high alert. Now consider a regulated utility. The questions are entirely different. We know people will need electricity next year. We know the company has a monopoly in its service area. We know within a very narrow range what rate of return the government regulators will allow them to earn on their investments. The risks are not gone, but they are known, quantifiable, and manageable. The primary risk is a change in the regulatory environment, a known variable that can be researched and monitored. There is no ambiguity about demand, competition, or the fundamental business model. This creates a state of psychological stability for the investor. It allows one to override the powerful urge to do something during a market panic. When the entire market is crashing because of a financial crisis or a pandemic, the owner of a utility stock can look at their holding and think, "People are still turning on their lights, the business is fine." This is a cognitive luxury that the owner of a speculative growth stock does not have. Their investment thesis might be shattered by the very events causing the panic. Buffett's strategy, therefore, is not just a financial one, it's a deeply psychological one. He is constructing a portfolio that is robust not only to economic shocks, but to his own human emotions. He is embracing our innate ambiguity aversion and using it as a shield. While other investors are on a neurological roller coaster of fear and greed, driven by the ambiguous narratives of the market, he is calmly collecting toll payments from an essential service, his decision-making brain protected by a fortress of regulatory certainty. This is the first and perhaps most important secret to long-term investing success. Structure your investments in a way that makes you the master of your own emotions rather than their servant. So how can you, as an individual investor, replicate this mindset? How can you build your own fortress of certainty? It comes down to a practical, repeatable mental model, a blueprint we can call the toll booth test. The goal is to identify businesses that function like an essential toll booth on the highway of the economy. A toll booth doesn't care if a Ferrari or a pickup truck drives through. It collects a fee from every single car. It's a business with an unavoidable structural advantage. Here is the step-by-step process for applying the toll booth test to find your own regulated monopoly investments. First, you must identify the, quote, essential service. The service provided must be non-discretionary, something that society cannot function without. We are talking about the absolute bedrock of modern life: electricity, natural gas for heating, clean water, and the essential transport of goods. These are not fads. The demand for these services is incredibly inelastic. It doesn't change much whether the economy is booming or in a recession. This is the first filter. If the business is selling something people want but don't fundamentally need, it fails the test. Second, you must map the regulatory landscape. This is the most crucial step and requires some homework. Every regulated utility is governed by a public body, often called a Public Utility Commission or a Public Service Commission at the state level. Your job is to become an expert on this relationship. Is the regulatory environment in their state of operation constructive or adversarial? You can find this out by reading the company's annual reports, specifically the sections on regulation, and even by reading the public dockets on the Commission's website. A constructive regulator understands the need for the utility to earn a fair return to attract capital and maintain the system. An adversarial regulator is constantly trying to score political points by suppressing rates, which ultimately harms the utility's ability to invest. The quality of the regulator is a primary determinant of the quality of the investment. Third, you must analyze the rate case history. This is where the rubber meets the road. Utilities can't just raise prices whenever they want. They have to go before their regulator in a legal proceeding called a rate case to justify any increase. They present their costs, their planned investments, and argue for a specific allowed return on equity, or ROE. This allowed ROE is the magic number. It's the percentage profit the regulator will let them earn on their capital base. You need to investigate the history. When was their last rate case? What ROE did they ask for? And what did they get? A healthy utility will consistently be granted ROEs in the range of, say, 9 to 11%. This history tells you exactly how predictable their future earnings will be. Fourth, assess the service territory. Not all monopolies are created equal. A utility operating in a state with a growing population and a business-friendly environment, like Florida or Texas, has a natural tailwind. More people and more businesses mean more demand for electricity and a larger rate base upon which to earn their allowed return. Conversely, a utility in a shrinking, deindustrializing region faces a headwind. Population growth is the organic growth engine for a utility, and it's a critical factor to assess for long-term compounding. Finally, look for non-regulated upside. The best utility companies often have a core, stable, regulated business, but also have smaller, unregulated operations that can provide an extra kick of growth. A great example is a company like NextEra Energy, which has a fantastic regulated utility in Florida Power and Light, but is also one of the world's largest generators of renewable energy from wind and solar, which it sells on the competitive market. This combination gives you the stability of the regulated business with the higher growth potential of a business exposed to the massive trend of the green energy transition. By methodically applying these 5 steps, you move beyond simple stock picking. You become a business analyst, capable of identifying the hidden fortresses in the market. You learn to distinguish between a truly durable, government-sanctioned moat and a temporary competitive advantage. This is how you build a portfolio for wealth building that lets you sleep soundly at night, knowing you own a piece of society's essential infrastructure, a toll booth that will keep collecting coins for you, day after day, year after year. To truly appreciate the wisdom of this path, we must examine its opposite. We must walk the path of the 99%, the path paved with excitement, narrative, and, all too often, financial ruin. This is the path of the unregulated free-for-all. It's the world of hyper-competition, where barriers to entry are low and the promise of explosive growth lures millions of investors and entrepreneurs into a brutal zero-sum game. Think of the industries that attract the most attention: new software applications, trendy restaurant concepts, direct-to-consumer retail brands, or social media platforms. The dream is intoxicating. You create an app, it goes viral, and you become a billionaire overnight. You open a unique coffee shop, it becomes a sensation, and you franchise it across the country. These stories, amplified by the media, create a powerful illusion of opportunity. What they mask is the brutal reality of survivorship bias. For every Instagram, there are 10,000 failed photo-sharing apps. For every Starbucks, there are 100,000 bankrupt cafes. The path of the 99% is defined by a complete absence of a moat. In these industries, competition is relentless and merciless. If you have a successful idea, it will be copied almost instantly. Margins are constantly under pressure. A software company has to contend with global competitors who can replicate their features in a matter of weeks. A restaurant has to compete with every other food establishment within a 5-mile radius. This constant competitive pressure is exhausting and financially draining. It forces companies to spend enormous amounts on marketing and advertising just to stay relevant. It creates a perpetual Red Queen's race, where you have to run as fast as you can just to stay in the same place. The dot-com bust of 2000 is the archetypal example of this folly. Investors poured billions into companies that had no structural advantages, no moats, and in many cases, no revenue. They weren't investing in businesses. They were betting on narratives. They were captivated by the story of the internet's transformative power, but they failed to ask the crucial question: how will this specific company capture a durable slice of that value? When the tide of easy money went out, it was revealed that most of these companies were swimming naked. They had no pricing power, no customer loyalty, and no defense against a wave of competitors. They were built on sand, and they were washed away. This is not just a historical anomaly. We see the same pattern repeat in every market cycle. Think of the cannabis stock boom, the 3D printing craze, or the recent implosion of many speculative technology stocks. The story is always the same. A compelling new technology or trend creates a narrative of unlimited growth. Investors, driven by a fear of missing out, pile in, ignoring traditional valuation metrics. Competition floods the space, profitability proves elusive, and the bubble eventually bursts, wiping out the majority of investors who arrived late to the party. The fundamental mistake is a failure to appreciate the destructive power of competition. Capitalism is a paradox. It is a brilliant system for society because it drives innovation and lowers prices through competition, but that very same competition is a nightmare for the owners of capital. Buffett's genius is his relentless focus on finding the rare businesses that are exempt from this brutal game. He seeks out the monopolies, the duopolies, the businesses protected by deep moats. By choosing the fortress of certainty, he sidesteps the unregulated free-for-all where capital goes to die. The 99% chase the story. Buffett buys the system. And that has made all the difference. The beauty of a government-sanctioned moat is not just a theoretical concept. It manifests with stark clarity on a company's financial statements. It creates a picture of stability and predictability that is the envy of the corporate world. Let's quantify this advantage and see how it translates directly into a massive financial edge. First, look at the income statement. For a typical industrial company, revenues can be a roller coaster, rising sharply in economic booms and plummeting during recessions. For a regulated utility, the revenue line is a gentle, upward-sloping hill. It is one of the most predictable numbers in all of finance. This low revenue volatility flows through the entire statement, leading to incredibly stable operating margins and net income. This stability has a profound effect on how the company is valued and perceived by the market. In portfolio theory, this is measured by, quote, beta. A stock with a beta of 1.0 moves in line with the market. A beta above 1.0 is more volatile, and a beta below 1.0 is less volatile. Most utility stocks have betas in the range of 0.4 to 0.6. This means that if the overall market falls by 10%, a typical utility stock might only fall by 4 or 5%. This provides enormous portfolio stability and acts as a powerful defensive buffer during market downturns, preserving capital when it is most at risk. Now let's look at the balance sheet. Because their revenues and cash flows are so predictable, regulated utilities can safely carry more debt than a cyclical company. A manufacturing company might get into serious trouble if its debt-to-equity ratio gets too high, because a sudden recession could make it impossible to service that debt. A utility, with its steady cash flows, can comfortably operate with a higher level of leverage. This is a powerful tool for financial engineering. By using low-cost debt to finance a portion of their assets, they can amplify the returns to shareholders. If a utility is allowed to earn a 10% return on its assets, and it finances half of those assets with debt that costs 5%, the return on the equity portion is magnified significantly. This prudent use of leverage is a direct result of the stability provided by the regulated monopoly. Finally, consider the cash flow statement, which is the heart of the dividend investing thesis. The predictable earnings translate directly into predictable cash from operations. This gives the company's management incredible clarity. They know, with a high degree of confidence, how much cash they will have available for years into the future. This allows them to do two things with remarkable consistency. First, pay a reliable and growing dividend, which is the cornerstone of generating passive income for a retirement portfolio. And second, lay out multi-billion-dollar, multi-year capital expenditure plans. This visibility is a luxury most CEOs can only dream of. They can plan for the long term, making massive investments in grid modernization or renewable energy, knowing that the regulatory framework will allow them to earn a return on those investments. This direct connection, from the legal concept of a regulated monopoly to the tangible numbers on the financial statements, is the entire machine of wealth building laid bare. The moat creates predictable revenues, which allows for safe use of leverage and provides stable cash flow, which in turn funds growing dividends and massive reinvestment in future growth. It is a simple, elegant, and incredibly powerful cycle of compounding. If the government-sanctioned moat is the fortress, then the ability to reinvest capital at predictable rates is the compounding machine hidden deep inside its walls. Owning a wonderful business is only half the battle. If that business cannot find intelligent ways to deploy the cash it generates, its value will stagnate. This is the second, and equally critical, part of Buffett's thesis. He loves utilities not just for their defensive characteristics, but for their voracious and productive appetite for capital. The perfect illustration of this principle in action came in May of 2005. The dot-com bust was a fading memory, and the market was beginning to feel the first tremors of the housing bubble that would eventually lead to the great financial crisis. In this environment, Berkshire Hathaway's energy division, still called Mid-American Energy at the time, made its next colossal move. It announced the acquisition of PacifiCorp, a large utility with operations spanning 6 western states, including Oregon, Utah, and Wyoming. The seller was a Scottish power company, and the price tag was a staggering $5.1 billion in cash, plus the assumption of over $4 billion in debt. To many observers, it looked like Buffett was simply buying another boring utility. But he and his team saw something much deeper. They weren't just buying a collection of existing power plants and transmission lines. They were buying a platform for future investment. Pacificorp's territory was vast, and its infrastructure was aging. More importantly, the region was rich in renewable resources, particularly wind. At the press conference announcing the deal, Buffett didn't talk about cutting costs or financial engineering. He talked about investing. He pledged that Berkshire would pour billions of dollars of new capital into Pacificorp's system. He spoke with genuine excitement about the opportunity to build thousands of megawatts of new wind generation in places like Wyoming and Iowa, and the massive new transmission lines that would be needed to carry that clean power to cities on the West Coast. This was the compounding machine in its purest form. Pacificorp was legally allowed to earn a fair return on new capital it invested in its system. Therefore, every $1 billion that Berkshire invested into upgrading the grid or building a new wind farm was almost guaranteed to generate $100 million or so in new annual earnings, year after year. For Buffett, who was sitting on a mountain of cash at Berkshire Hathaway that was earning next to nothing, this was a dream come true. He famously said, "We have a lot of money, and our problem is we can't find things to do with it. This is a business that is going to need a lot of capital." It was the perfect marriage, a business with a near insatiable need for capital, and an owner with a near endless supply of it. The Pacificorp acquisition transformed Berkshire's energy operations from a regional player into a national powerhouse. More importantly, it established a template that they would repeat again and again. They would buy a regulated utility, improve its operations, and then use it as a conduit to pour billions of dollars into productive, long-term infrastructure projects, all while earning a stable, government-sanctioned rate of return. This is the often missed offensive power of investing in boring stocks. The moat provides the defense, but the mandated reinvestment opportunity provides the growth. It is a slow, methodical, and incredibly powerful engine for compounding wealth, turning today's earnings into the foundation for tomorrow's even larger earnings. The psychological principle that underpins this reinvestment strategy is one of the most studied and most difficult for humans to master: delayed gratification. It's the core concept behind the famous marshmallow test conducted by psychologist Walter Mischel at Stanford University in the 1960s and 70s. In the experiment, a child was placed in a room with a single marshmallow on a plate. The researcher told the child they could eat the marshmallow immediately, but if they could wait for 15 minutes until the researcher returned, they would be given a second marshmallow. It was a simple test of willpower. The follow-up studies years later were astounding. The children who had been able to delay gratification and wait for the second marshmallow went on to have higher SAT scores, better educational attainment, and healthier lives. They were more successful. Investing in a compounding machine like a utility is the financial world's version of the marshmallow test. A company has a choice with every dollar of profit it earns. It can give it to you immediately, in the form of a high dividend, eating the first marshmallow now. Or, it can retain that dollar and reinvest it back into the business in a project that will earn a high rate of return, producing even more dollars in the future, which will fund much larger dividends down the road, waiting for the second marshmallow. Our brains are hardwired by evolution to prefer the immediate reward. This is a cognitive bias known as hyperbolic discounting. We place a much higher value on a reward we can get today than a reward we can get tomorrow. A promise of $100 a year from now feels much less valuable than $50 in our hand right now. This is why so many investors are drawn to stocks with the highest possible current dividend yields. It satisfies that primal craving for immediate gratification. They want the marshmallow now. The genius of Buffett's approach is his ability to completely override this instinct. He is the ultimate master of delayed gratification. He understands that the true magic of wealth building comes not from what a business earns today, but from how much of today's earnings can be reinvested at high rates to create a tidal wave of earnings in the future. A utility with a massive multi-year capital investment plan is the perfect vehicle for this. The management is essentially telling you, we are going to be disciplined. We are going to retain a significant portion of our earnings and reinvest them in projects where the government has already agreed to give us a 10% return. It's the closest thing you can find to a guaranteed second marshmallow. By choosing these businesses, you are aligning your capital with a corporate culture of delayed gratification. You are forcing yourself to be patient. You are participating in a system designed for long-term compounding, shielding you from your own brain's worst instinct to grab the quick, easy reward at the expense of a much larger future fortune. It's a profound psychological shift. You stop thinking like a speculator, hoping for a quick gain, and start thinking like an owner, patiently planting seeds that you know will grow into a mighty forest. Translating this powerful theory into action requires a new mental model, a tool for your investing toolkit. Let's call it the Reinvestment Runway Calculator. This is not a complex financial formula, but a logical framework for assessing a company's ability to productively reinvest its capital and compound its intrinsic value over time. It consists of 4 key steps. The first step is to calculate the company's reinvestment rate. In simple terms, this tells you what percentage of the company's earnings are being plowed back into the business rather than being paid out as dividends. You can approximate this by looking at their financial statements. Take their capital expenditures, subtract their depreciation, which is the cost of maintaining current assets, and you have their growth capex. Divide this number by their net income. A company with a high reinvestment rate is signaling a strong focus on growth. A utility that is spending billions on new wind farms or grid upgrades will have a much higher reinvestment rate than a stagnant utility that is just maintaining its old equipment. The second step is to determine the return on that reinvested capital. It's no good to reinvest a lot of money if you're earning poor returns on it. This is where the beauty of the regulated utility model shines. The return on invested capital, or ROIC, is largely predetermined by the regulators. If a utility's allowed return on equity is 10%, then you can be confident that $1 of reinvested earnings will generate about 10 cents of new profit in the future. For a non-regulated business, this number is far more speculative and uncertain. For a utility, it's about as close to a sure thing as you can get. The third step is to project the compounding rate. The intrinsic value of a business will grow over the long term at a rate that is roughly the product of the first 2 steps. That is, reinvestment rate multiplied by the return on invested capital. Let's take an example. A utility earns $1 billion. It pays out $400 million in dividends and reinvests the remaining $600 million. Its reinvestment rate is 60%. It earns a 10% return on that new capital. Its intrinsic value will compound at approximately 6% per year, 60% times 10%. This simple calculation provides a powerful estimate of the company's underlying growth engine, stripping away the noise of daily stock price fluctuations. The final and most important step is to evaluate the runway. How long can the company continue to reinvest at these high rates? This is a qualitative judgment. A company that has run out of good ideas will see its return on investment decline. A great business has a long runway of opportunities. For utilities today, the runway is enormous. You need to read their investor presentations and annual reports. They will explicitly lay out their capital investment plans for the next 5 or 10 years. A utility that says, "We plan to invest $20 billion over the next 5 years to achieve 80% carbon-free energy," is showing you a very long and clear reinvestment runway. The societal need to modernize the grid, transition to renewable energy, and support the electrification of transport creates a multi-trillion-dollar, multi-decade opportunity. By using this 4-step framework, you can systematically identify the best compounding machines in the market. You move beyond simple dividend yield and start to appreciate the true driver of long-term returns, the profitable reinvestment of retained earnings. You will learn to favor a company paying a 3% dividend but compounding its intrinsic value at 7% over a company paying a 6% dividend but with 0 growth prospects. This is the mindset that separates amateur income investors from professional wealth builders. The path of the 99% offers a stark and tragic contrast. It is the path of chasing growth at any price, a seductive narrative that frequently ends in disaster. This fallacy is rooted in a simple but profound mistake, extrapolating a company's past growth rate far into the future, without rigorously asking if it has a long enough reinvestment runway to support that growth. Imagine a successful company that has invented a brilliant new product. For 5 years, it grows at 50% per year. The stock becomes a market darling, and its valuation soars to astronomical levels. Investors fall in love with the growth story. The problem is that all great markets eventually become saturated. The company runs out of new customers to sell its product to. The explosive growth inevitably slows. At this point, the company's management faces a critical choice. The disciplined choice is to acknowledge the new reality, slow down their investment, and start returning more cash to shareholders in the form of dividends or buybacks. The dangerous choice, the one many companies make, is to try and maintain the illusion of high growth at all costs. This leads to a phenomenon that Buffett colorfully calls diversification. The company, flush with cash from its glory days and pressured by Wall Street to keep growing, starts making desperate acquisitions. A successful software company might suddenly decide to buy a struggling hardware manufacturer. A popular beverage company might venture into the fashion industry. They venture far outside their circle of competence, often paying ludicrously high prices for mediocre businesses, all in the name of synergy and expanding their total addressable market. In reality, they are destroying shareholder value. They are taking capital that could have been returned to shareholders and reinvesting it at abysmally low rates of return. The growth story they are trying to sell is a mirage. Investors who are still fixated on the company's historical growth rate fail to see what's happening. They don't apply the reinvestment runway calculator. They see growth in revenue from the new acquisitions, but they don't see that the return on that new invested capital is terrible. The company gets bigger, but it doesn't get more valuable on a per-share basis. Eventually, the market wakes up. A few bad quarterly earnings reports come out, the narrative shatters, and the stock price collapses. The investors who bought in at the peak, captivated by the story of perpetual growth, are left holding the bag. This is a story that has played out thousands of times in market history. It's the fate of companies that were once great but failed to adapt when their reinvestment runway ended. The lesson is clear. High growth is only valuable if it is accompanied by high returns on new capital. Without a long runway of profitable reinvestment opportunities, a growth company can quickly become a wealth-destroying machine. The quiet, predictable utility, with its government-approved, multi-decade runway of necessary infrastructure projects, is the perfect antidote to this dangerous fallacy. It offers not the illusion of growth but the reality of methodical, profitable, and sustainable compounding. Let's trace the journey of a single dollar to see how this compounding machine translates into tangible financial results. This is the direct financial connection between a utility's reinvestment strategy and an investor's growing wealth. Imagine a well-run, regulated utility, let's call it Certainty Power and Light, earns $1 of profit per share. The company's management, guided by a long-term vision, decides on a 60% dividend payout ratio. This means you, the shareholder, receive 60 cents as a cash dividend, a direct stream of passive income into your brokerage account. The remaining 40 cents is retained by the company. This 40 cents of retained earnings appears on the statement of cash flows as cash from operations that is not paid out. Now, the magic begins. Certainty Power and Light takes that 40 cents per share and combines it with money raised from issuing low-cost, investment-grade bonds. They use this pool of capital to fund their capital expenditure, or CapEx program. Let's say they invested in building a new, highly efficient solar farm. This new solar farm is then added to the company's rate base. The rate base is the total value of the assets that the regulator allows the company to earn a return on. So the company's rate base has now grown. At their next rate case, the company goes to the Public Utility Commission and says, "We have invested in this new solar farm to better serve our customers with clean, reliable energy. We request to earn our allowed 10% return on this new asset." The regulator, having already approved the project, agrees. That initial 40 cents of reinvested capital is now legally entitled to generate 4 cents of new, recurring annual profit, 10% of 40 cents. This boosts the company's total earnings per share in the following year. Now, instead of earning $1, the company earns $1.04. The cycle then repeats, but from a higher base. The board, maintaining its 60% payout ratio, increases the dividend. The new dividend is now 62.4 cents, 60% of $1.04, a 4% increase from the previous year. The company also has more retained earnings to reinvest for the next year, 41.6 cents. This virtuous cycle is the very essence of compounding. The retained earnings fund new investments. The new investments grow the rate base. The larger rate base generates higher total earnings. The higher earnings fund a larger dividend and even more retained earnings to start the cycle all over again. It is a financial snowball, rolling downhill, getting bigger and bigger with each rotation. For the long-term investor, the result is a dual benefit. Your stream of passive income, the dividend, grows predictably every single year. Simultaneously, the intrinsic value of the business, its underlying earning power, is also growing. This is the quiet, beautiful, and unstoppable arithmetic of a true compounding machine at work. It's how fortunes are built, not by speculating on what a stock price might do tomorrow, but by understanding and owning the underlying business process that creates value over decades. To truly grasp the power of boring, we must witness it in its natural habitat, a time of maximum fear. The setting is the fall of 2009. The world is still reeling from the great financial crisis. The collapse of Lehman Brothers a year earlier had triggered a global panic, and the financial system had come to the brink of annihilation. Confidence was shattered. The stock market had been cut in half. Unemployment was soaring. The headlines were filled with talk of a second Great Depression. It was a time of pervasive, gut-wrenching fear. In this environment, most investors were paralyzed, hiding in cash or government bonds, terrified of losing what little they had left. But Warren Buffett was doing what he does best in a crisis. He was shopping. And he wasn't buying beaten-down bank stocks or speculative technology companies. He was buying a railroad. On November 3, 2009, Berkshire Hathaway announced it would acquire the 77.4% of the Burlington Northern Santa Fe (BNSF) Railway that it didn't already own, in a deal valued at $34 billion. It was the largest acquisition in Berkshire's history. At the time, the deal was met with confusion by some. Why a railroad? Railroads were a 19th-century technology. They were capital-intensive, unionized, and economically sensitive. They were, in a word, boring. But Buffett saw something else. He saw an essential artery of the American economy. BNSF was not just a collection of tracks and locomotives. It was a critical piece of infrastructure. It moved the grain from the farms of the Midwest to the ports for export. It moved the coal that powered the nation's electricity plants. It moved the consumer goods from the ports of California to the distribution centers in Chicago. If America was going to have an economic future, it needed its railroads. In his announcement, Buffett famously called the deal an, quote, all-in wager on the economic future of the United States. It was a profound statement of optimism at a time of deep pessimism. But beneath that patriotic sentiment was a cold, hard business calculation. BNSF possessed one of the most powerful moats in existence. The railroad industry in North America is a natural duopoly. In any given region, there are typically only two major railroads, BNSF and its rival Union Pacific in the West. Building a competing transcontinental railroad today would be practically impossible. The cost would be in the trillions, and the political and environmental hurdles of acquiring the land would be insurmountable. This structural advantage gives railroads immense pricing power and durability. Furthermore, like a utility, a railroad is a business that requires massive, continuous capital investment to maintain and improve its network. It was another perfect business for Buffett's compounding machine. It had an endless runway for reinvestment in new tracks, new bridges, more efficient locomotives, and safer signaling systems. It was a business that could soak up billions of Berkshire's capital and earn good returns on it for decades to come. The BNSF acquisition was the ultimate expression of the boring is beautiful philosophy. While others were panicking, Buffett focused on the essential, the durable, and the certain. He ignored the terrifying headlines and looked at the underlying economic reality. People and goods would always need to be moved from point A to point B. By buying a critical, irreplaceable piece of the system that does that moving, he was making a bet not on the sentiment of the next year, but on the certainty of the next century. Why do we consistently make the opposite choice? Why are we, as investors, so drawn to the exciting, narrative-driven, and often ephemeral businesses, while ignoring the durable, boring ones? The answer lies in another deep-seated cognitive bias, salience bias, amplified by what the great thinker Nassim Nicholas Taleb calls the narrative fallacy. Salience bias describes our tendency to focus on items or information that are prominent, emotionally striking, and easily noticeable, while ignoring those that are unremarkable, even if the unremarkable information is statistically more important. The story of a visionary 25-year-old founder in a hoodie who drops out of college to start a company that will change the world is incredibly salient. It's a modern-day hero's journey. It's exciting, emotionally resonant, and makes for a great headline. The story of a 60-year-old utility CEO in a gray suit who is methodically executing a 5-year, $10 billion plan to upgrade transmission lines is the opposite of salient. It's boring, it's complex, it puts you to sleep. Our brains, which evolved to pay close attention to sudden dramatic events, like the appearance of a saber-toothed tiger, are naturally drawn to the first story and completely overlook the second. This is compounded by the narrative fallacy. Humans are story-telling creatures. We crave simple, coherent explanations for complex and random events. We want the world to make sense. The market is a chaotic, complex, adaptive system, but we impose simple stories on it to feel like we are in control. The narrative of disruptive innovation, for example, is incredibly powerful. It's a simple story. A new technology comes along and displaces the old guard. Investors who back the disruptor will make a fortune. This narrative was the driving force behind the boom and subsequent bust of the ARK Innovation family of ETFs between 2020 and 2022. During the pandemic, the story of a future dominated by genomics, robotics, and artificial intelligence became overpoweringly salient. The fund's manager became a celebrity, and money poured in. Investors weren't buying a collection of businesses based on their current cash flows or balance sheets. They were buying a story about the future. They fell victim to the narrative fallacy. The problem is that while the broad story of technological progress is true, picking the specific individual winners in advance is extraordinarily difficult. For every successful disruptor, there are hundreds of failures. When the economic environment changed and interest rates began to rise, the valuations of these long-duration companies whose value was based on the promise of distant future profits, collapsed. The narrative shattered, and investors who had bought into the hype suffered catastrophic losses. The boring utility or railroad, meanwhile, just kept chugging along. Its value was not based on a speculative story about the distant future, but on the tangible cash flows it was generating in the present. Buffett's entire approach is a conscious and disciplined effort to resist the siren song of salience and narrative. He forces himself to ignore the exciting stories and focus on the boring but far more predictable mathematics of business. He knows that fortunes are not built by correctly guessing the plot of the next great story. They are built by owning the unglamorous stage upon which all the stories play out. To make this principle practical, you need a mental filter. A simple set of questions you can ask to separate businesses with enduring, boring certainty from those built on exciting but fragile narratives. Let's call this filter, "Will this matter in 20 years?" It's a powerful tool for cultivating long-term vision. The first question is the essential need test. Does this business satisfy a fundamental, unchanging human or economic need? Think about the base of Maslow's hierarchy of needs. People will always need shelter, warmth, light, water, and food. The economy will always need energy and the transportation of goods. A water utility passes this test with flying colors. A new social media app that connects pet owners, while potentially a fun business, fails. In 20 years, the need for clean water will be more critical than ever. The pet app will likely be a distant memory, replaced by a dozen newer fads. The second question is the technological obsolescence risk test. Could a new technology completely eliminate or dramatically shrink the market for this business in the next 2 decades? This is where you must be brutally honest. The business model of a newspaper was destroyed by the internet. The business of a video rental store was destroyed by streaming. Now apply this to our examples. Could a new technology eliminate the need for the electrical grid? It's highly unlikely. In fact, most new technologies, from electric vehicles to artificial intelligence, dramatically increase the demand for electricity. The grid becomes more important, not less. The risk of obsolescence for a regulated utility or a railroad is remarkably low. The third question is the competitive landscape durability test. Is the company's competitive advantage structural and likely to persist, or is it based on something fleeting like a brand or a temporary technological lead? A regulated monopoly or a railroad duopoly has a structural advantage protected by physics and law. It is incredibly durable. A company whose main advantage is a hit product or a clever marketing campaign has a much more fragile position. Tastes change, and competitors can copy marketing. You are searching for advantages that are almost impossible to replicate. The fourth and final question is the simplicity test. Can you explain in simple terms how this business makes money to a reasonably intelligent 10-year-old in under 2 minutes? If the answer is no, you are likely dealing with a business whose complexity may be hiding significant risks. A utility makes money by generating and selling electricity to people, and the government lets them make a small profit. Simple. A railroad makes money by charging people to move their stuff on its trains. Simple. Now try to explain the business model of a complex derivatives trading firm or a biotechnology company whose value rests on the outcome of a Phase 3 clinical trial. If you don't truly understand it, you cannot possibly assess its long-term durability. By applying this 4-question filter, you can systematically immunize yourself against the narrative fallacy. It forces you to look past the exciting stories and focus on the deep, structural characteristics that allow businesses to endure and compound wealth for generations. It is the mental discipline required to choose certainty over hype. The most direct financial consequence of choosing boring over exciting is the profound impact of volatility on long-term returns. This is not an intuitive concept, but it is a mathematical certainty. Avoiding large losses is far more important than achieving spectacular gains. This is the power of low volatility compounding. Let's illustrate this with a simple, stark example. Imagine 2 investors, Anna and Ben, who each start with $100. Anna is a speculator. She chases exciting, high-flying stocks. In year 1, the market is hot, and she has a fantastic year, making 50%. Her $100 grows to $150. She feels like a genius. Ben is a boring investor. He owns a portfolio of utilities and other stable dividend-paying stocks. In year 1, he has a solid but unspectacular year, making 10%. His $100 grows to $110. He feels sensible, but a little bit envious of Anna's spectacular return. Now, in year 2, the market turns. A recession hits, and the exciting high-beta stocks that Anna owns get crushed. Her portfolio falls by 40%. The math here is crucial. A 40% loss on $150 is $60. Her portfolio value drops to $90. After 2 years of thrilling highs and terrifying lows, she has lost 10% of her original capital. Ben's boring portfolio, with its low beta and stable earnings, also declines, but much less. It falls by only 10% in the downturn. A 10% loss on his $110 is $11. His portfolio value drops to $99. After 2 years of steady, boring progress, he is down only 1%. Let's extend this for one more cycle. In year 3, the market recovers. Anna's portfolio soars again. up 50%. Her $90 grows to $135. Ben's portfolio chugs along, up 10%. His $99 grows to $108.90. After 3 years, Anna has a higher number. But what happens when the next downturn comes? The violent swings in her portfolio make it incredibly difficult to compound capital effectively. The arithmetic of loss is brutal. If you lose 50% of your capital, you need a 100% gain just to get back to even. The path to wealth is not a sprint, it's a marathon. The investor who minimizes drawdowns and consistently earns a reasonable rate of return will, over the long run, almost always outperform the speculator who experiences wild swings. This concept is formalized in finance with a metric called the Sharpe ratio, which measures a portfolio's return relative to its risk or volatility. Boring stocks, like utilities, consistently exhibit higher Sharpe ratios over long periods than the market as a whole. They deliver better risk-adjusted returns. This isn't just theory. It's the mathematical reality of compounding. By building a portfolio that is designed to be less volatile, you are not being timid, you are being smart. You are harnessing the relentless, unforgiving mathematics of compounding in your favor. You are protecting your capital from the permanent impairment that comes from large drawdowns, ensuring that your financial snowball can keep rolling, uninterrupted for decades. That is the ultimate financial advantage of being boring. Once you understand the power of these quiet, durable businesses, the next logical step is to integrate them into your own financial life. How do you build a bedrock of certainty that can support your long-term goals, like a secure retirement portfolio? This is where we can learn from Warren Buffett's advice to ordinary investors. While Berkshire Hathaway is a complex machine making billion-dollar bets, Buffett's advice for individuals has always been remarkably simple. For most people, he advocates for a low-cost S&P 500 index fund. But a crucial part of his philosophy is to understand what you own. The principle of investing in utilities and essential infrastructure is not about abandoning index funds. It's about complementing them. It's about building a core position in your portfolio, a sleep-well-at-night allocation that you understand on a deep, fundamental level. Think of it as a personal endowment. This mirrors Buffett's own history. Before Berkshire became the behemoth it is today, his investment partnership was built on a collection of deeply understood, predictable businesses, like American Express and the Washington Post. He saw them not as flickering stock quotes, but as businesses with durable moats and predictable earning power. For an individual investor seeking passive income and portfolio stability, a hand-picked collection of high-quality utility stocks can serve the exact same function. This is about taking direct ownership and responsibility for a portion of your financial future. When you own an index fund, you own a sliver of hundreds of companies, the good, the bad, and the mediocre. You are diversified, but you are also detached. When you own shares in your local electric utility, you can see their trucks in your neighborhood. You are a customer. You understand their business model in a tangible way. This creates a powerful psychological anchor, especially during times of market turmoil. It's much harder to panic and sell a business you fundamentally understand than it is to sell a ticker symbol you barely recognize. Building this bedrock is an act of financial empowerment. It's a declaration that you will not be a passive victim of the market's whims, but an active owner of durable, essential assets. It is the foundation upon which a truly resilient and lifelong investment strategy can be built. The act of building this bedrock has a profound, and often overlooked, psychological benefit. It serves as a powerful antidote to two of the most destructive behavioral biases in investing: the endowment effect and regret aversion. The endowment effect is our irrational tendency to overvalue something simply because we own it. If someone gives you a coffee mug, you might value it at $5. But if you were asked to sell that same mug, you might demand $10 for it. Ownership creates an emotional attachment that inflates our perception of value. This effect can be dangerous with speculative stocks. You buy a stock, it goes up, and the endowment effect convinces you it's a great company, even if the price has become detached from reality. You become unwilling to sell, blinded by ownership. Regret aversion is the flip side of this coin. It is our desire to avoid the pain of feeling responsible for a bad outcome. This leads to two common mistakes. First, we sell our winners too early. We lock in a small gain to avoid the potential regret of watching it turn into a loss. Second, and more destructively, we hold on to our losers for far too long. We refuse to sell a stock that has gone down, because selling would mean admitting we made a mistake, and the pain of that regret feels unbearable. We tell ourselves, "I'll sell when it gets back to even," a financially irrational but emotionally comforting strategy. A core holding of boring, steady utility stocks helps to short-circuit these emotional traps. Their slow and steady nature doesn't trigger the intense emotional swings of a high-flying tech stock. The endowment effect is less potent because the investment thesis isn't based on an exciting story but on a stable, predictable business model. You're less likely to fall in love with your electric company. More importantly, it dramatically reduces regret aversion. During a market crash, the fundamental reason for owning a utility, that people need electricity, remains unchanged. Its business is resilient. You feel less pressure to sell because the underlying asset is sound. This emotional stability is a form of hidden alpha. It prevents you from making the big, emotionally driven mistakes that sabotage most investors. Returns over the long term. By consciously choosing to build a bedrock of boring investments, you are not just constructing a financial portfolio, you are constructing a psychological fortress. You are creating an environment where you are less susceptible to the biases that lead others astray, allowing you to stay the course and let the power of compounding work its magic, undisturbed by your own worst instincts. So how do you put this into practice? Let's create a tangible blueprint, a mental model for action. We'll call it the All-Weather Income Portfolio Constructor. This is a step-by-step guide to building the utility and infrastructure sleeve of your portfolio, designed for resilience and the generation of growing passive income. The first step is to clearly define your goal. Are you in your accumulation years, primarily focused on total return and long-term compounding? Or are you nearing or in retirement, where the primary goal is generating a reliable stream of current income to live on? Your answer will influence your stock selection. A younger investor might favor a utility with a lower current dividend, but a higher reinvestment rate and thus a faster growth rate. A retiree might prefer a more mature utility with a higher current dividend yield and a slightly slower growth rate. Honesty about your goal is the critical starting point. The second step is the core selection. This should make up the majority of this sleeve, say 70%. Here you want to select between 3 and 5 of the highest quality, most financially sound regulated utilities you can find. You are looking for companies with A-rated credit or better, which signals a very strong balance sheet. They should operate in states with constructive regulatory environments. Remember the toll booth test. And they should have a long, unbroken history of not just paying, but consistently increasing their dividend each year. Companies that have done this for over 25 consecutive years are known as dividend aristocrats, and they are a great place to start your research. This core is your bedrock of stability. The third step is to add a growth kicker. This will be the remaining 30% of the sleeve. Here, you can add 1 or 2 companies that have a bit more growth potential, while still being grounded in the world of essential infrastructure. This could be a best-in-class renewable energy developer, a major railroad company, or a diversified infrastructure holding company. These businesses might have slightly lower dividend yields, but offer a higher potential for capital appreciation, giving your portfolio an extra boost over the long term. They complement the staid reliability of your core utility holdings. The fourth and final step is to establish an automated plan for rebalancing and reinvestment. You must decide this up front, before emotions can interfere. Will you enroll in a dividend reinvestment plan, DRIP, where all your dividends are automatically used to purchase more shares, fueling the compounding snowball? And will you rebalance your portfolio, say, once a year, to bring it back to your target 70/30 allocation? For example, if your growth kickers have a great year and now represent 40% of the sleeve, your rebalancing rule would force you to sell some of the winners and buy more of the stable core. This is a disciplined way to sell high and buy low, a strategy that is simple in theory but emotionally difficult in practice. By automating this plan, you remove your own flawed decision-making from the equation. Following this 4-step blueprint allows you to build a robust, intelligent, and emotionally resilient foundation for your financial future. It's a structured approach to harnessing the quiet power of boring stocks for wealth building and achieving true portfolio stability. One of the most common and disastrous mistakes investors make, especially those seeking passive income, is the yield chaser's demise. This is the path of the 99% in the world of dividend investing. It begins with a seemingly logical but deeply flawed process: screening for stocks with the highest possible dividend yield. An investor will go to a financial website, sort all stocks by dividend yield, and be instantly attracted to the companies at the top of the list, those paying out 10, 15, or even 20%. To the untrained eye, this looks like a shortcut to financial freedom. Why would I settle for a 3% yield from a utility, they ask, when this company is paying 15%? The reason, all too often, is that an abnormally high dividend yield is not a sign of a great investment, but a giant red flag, a warning sign of a business in deep distress. The dividend yield is a simple calculation: the annual dividend per share divided by the current stock price. The yield can go up for two reasons. Either the company raised its dividend, a good sign, or the stock price has fallen dramatically, a very bad sign. In the case of these ultra-high-yield stocks, it is almost always the latter. The market is screaming that it has lost confidence in the company's future and is pricing in a high probability that the dividend will have to be cut. The yield chaser, blinded by the allure of the big payout, ignores this warning. They buy the stock, collect one or two fat dividend checks, and feel smug. But they are picking up pennies in front of a steamroller. Let's take a common example: a master limited partnership, MLP, that owns a declining pipeline asset, or a regional telecom company losing customers to larger rivals. The business is fundamentally deteriorating. Its cash flows are shrinking. Management, however, is reluctant to cut the dividend because they know it's the only reason anyone owns their stock. So they continue to pay it, often by taking on more debt or underinvesting in their own business, further accelerating the decline. Finally, the day of reckoning arrives. The company announces that, due to declining cash flows, it can no longer afford the dividend and is cutting it by 80% or eliminating it entirely. The result is a double catastrophe for the yield chaser. First, their expected stream of passive income vanishes overnight. Second, the stock price, which was being propped up solely by the unsustainable dividend, collapses. It is not uncommon for such a stock to fall 50% or more on the day of the announcement. The investor who chased the 15% yield is left with no income and a massive capital loss. They have fallen into the ultimate value trap. This tragic story highlights the critical importance of focusing on dividend safety and dividend growth, not just the current yield. A healthy, growing 3% yield from a blue-chip utility is infinitely superior to a precarious 15% yield from a dying business. The path to building a reliable retirement portfolio is paved with boring, predictable dividend growers, not seductive but deadly yield traps. Let's put some numbers to this to see the tangible, life-changing power of this approach. We're going to illustrate the dividend snowball effect, the direct financial connection that turns a modest investment into a significant source of passive income over time. This is the mathematics of dividend investing done right. Imagine you are 40 years old and you invest a lump sum of $25,000 into a carefully selected basket of high-quality utility stocks, following the all-weather constructor model. Let's assume this portfolio has an average dividend yield of 3.5% and, based on its history and reinvestment runway, is able to grow its dividend by a conservative 6% per year. You enroll in a DRIP, so all dividends are automatically reinvested. Now let's watch what happens. In year 1, Your $25,000 investment generates $875 in dividends. That $875 is automatically reinvested, buying more shares. Your principal is now $25,875. In year 2, the companies raise their dividends by 6%. You now earn a 3.71% yield on your original investment, and because you own more shares, your total dividend income for the year is $986. This is reinvested, and your principal grows again. Notice the two engines of growth at work. You are accumulating more shares, and the dividend paid per share is also increasing. This is the snowball effect. Let's fast forward. By year 10, your annual dividend income has grown to over $1,900 per year. Your initial $25,000 investment is now worth over $46,000, assuming no change in the underlying stock price, just from the reinvested dividends. But the magic is just beginning. Let's jump ahead to year 20, when you are 60 and starting to think about retirement. Your annual dividend income from that single initial $25,000 investment is now over $4,600. That's a yield on your original cost of over 18%. Your total portfolio value has swelled to more than $88,000. And if we look forward to year 25, right at retirement age, your annual passive income stream from this one investment is nearly $7,000 per year, and the total value has surpassed $120,000. This is not a get-rich-quick scheme. It is a get-rich-for-sure plan. It demonstrates with mathematical certainty how a combination of a reasonable starting yield, consistent dividend growth, and the discipline of reinvestment can create a powerful, exponentially growing stream of income. This is the tangible financial goal. This is how you build a retirement portfolio that can support you for the rest of your life, a fortress of income built brick by boring brick. As we move into the 21st century, the story of Berkshire Hathaway's infrastructure empire only gets bigger and more impressive, solidifying its place as one of the unseen giants of the American economy. The foundational acquisitions of Mid-American and Pacificorp were just the beginning. The compounding machine was hungry. In 2013, Berkshire Hathaway Energy, BHE, made another massive move, acquiring NV Energy, the primary electric utility for Nevada, for $5.6 billion. The logic was impeccable. Nevada was a high-growth state, and the acquisition connected BHE's assets in the Pacific Northwest with its assets in the Rocky Mountains, creating a vast, integrated western grid. But perhaps the most telling anecdote comes from a deal that didn't happen. In 2017, the giant Texas utility, Oncor, was in bankruptcy protection as a result of the failure of its parent company. Oncor was a prize asset, a huge, well-run utility in the booming Texas market. A bidding war erupted, involving multiple private equity firms. Into this complex and messy situation stepped Warren Buffett. He made a simple, clean, all-cash offer of $9 billion. His pitch was classic Buffett. We're offering a clean deal with a Berkshire Hathaway guarantee. We'll be a long-term owner, we'll invest in the business, and we'll be a great partner for the state of Texas. For a time, it looked like his offer would win. The bankruptcy judge and Oncor's management favored the simplicity and certainty of Berkshire's bid. But at the last minute, another utility, Sempra Energy, came in with a slightly higher offer of $9.45 billion. Buffett was faced with a choice. He could easily afford to raise his bid. He desperately wanted the asset. It was a perfect fit. But he had determined what Oncor was worth to him, and he was not willing to go a single penny higher. Berkshire withdrew its offer. This moment is a masterclass in value investing discipline. Even for the perfect asset, price matters. Buffett's refusal to get caught up in the heat of a bidding war, his unwavering commitment to his calculation of intrinsic value, is a lesson for every investor. The temptation to overpay for a wonderful business is immense. But the discipline to walk away when the price is no longer right is the hallmark of a master. BHE would go on to make other acquisitions, like Dominion Energy's gas transmission and storage assets in 2020. The story of its growth is one of relentless, disciplined, methodical execution. It is the ultimate case study of the entire thesis. Buy wonderful, essential, regulated businesses, but only at a sensible price, and then pour capital into them for decades to create an unstoppable engine of compounding. This unwavering discipline is rooted in one of Buffett's most famous concepts, the circle of competence. And this in turn is a powerful psychological defense against one of the most insidious cognitive biases, the Dunning-Kruger effect. The Dunning-Kruger effect, identified by two social psychologists, is the bias in which people with low ability at a task tend to overestimate their ability. In short, they are too incompetent to recognize their own incompetence. The world of investing is a playground for the Dunning-Kruger effect. A novice investor makes a few lucky bets on some speculative stocks during a bull market and starts to believe they are a financial genius. They mistake luck for skill. Emboldened by their overconfidence, they take bigger and bigger risks, often venturing into complex areas they know nothing about, like options trading or biotechnology stocks. The end result is almost always disastrous. Buffett's entire career is a testament to the opposite mindset. He possesses what Charlie Munger calls a, quote, special kind of humility. He is acutely, almost painfully aware of the boundaries of his own knowledge. He defines his circle of competence as the industries and businesses that he can understand with a very high degree of confidence. Inside that circle are businesses like insurance, consumer brands, banking, and, of course, utilities and infrastructure. Outside that circle are things like high technology, pharmaceuticals, and mineral exploration. He simply does not venture outside the circle. He doesn't try to predict the next breakthrough in semiconductor design. He doesn't have an opinion on which company will win the race for artificial general intelligence. He readily admits, "I don't know." These three words are some of the most powerful and wealth-preserving in the English language. What is so powerful about the utility and infrastructure sector is that its circle of competence is learnable for a dedicated individual investor. You do not need a PhD in physics to understand how an electric company makes money. You do not need an advanced degree in computer science to understand the business model of a railroad. The concepts of a rate base, an allowed ROE, and a reinvestment runway are all understandable through diligent reading of a company's public documents. By consciously choosing to invest in these boring, understandable businesses, you are effectively drawing your own circle of competence. You are protecting yourself from the Dunning-Kruger effect. You are admitting that you probably can't pick the winner in the gene editing revolution, and that's okay. You are choosing to play a game that you can win, a game of certainty, predictability, and long-term compounding, while avoiding the dangerous game of speculation that so many others are destined to lose. To truly master this way of thinking, we need one final mental model. This one is about zooming out, looking beyond the next quarter or the next year, and identifying the powerful, multi-decade tailwinds that will propel this investment thesis forward. Let's call this model the century-long trend identifier. It's about seeing the future not as a series of random events, but as the logical unfolding of deep, structural forces. The first and most powerful trend is the electrification of everything. For the last century, our economy was built on burning fossil fuels. The next century will be built on running on electricity. The transition to electric vehicles is just the beginning. We are moving towards electric heat pumps for our homes, electric induction stoves in our kitchens, and ever more powerful computers and data centers. Every single one of these trends represents a massive, sustained increase in the demand for electricity. This requires a colossal investment in not just new power generation, but in hardening and expanding the electrical grid itself. The boring utility is at the absolute center of this multi-trillion-dollar transformation. The second trend is the green transition. The global shift away from carbon-emitting energy sources towards renewables like wind, solar, and next-generation nuclear is the largest capital reallocation project in human history. This is not a political statement, it is an economic reality, and it requires infrastructure. It requires billions of dollars for new solar farms in the desert and thousands of new wind turbines on the plains. But most critically, it requires a massive build-out of new high-voltage transmission lines to carry that clean energy from the sunny and windy places where it is generated to the population centers where it is consumed. Investing in the owners and operators of that new infrastructure is a direct bet on this unstoppable, century-long trend. The third trend is onshoring and supply chain resilience. The pandemic and geopolitical tensions have exposed the fragility of global supply chains. There is a powerful political and economic push to bring critical manufacturing back to the United States. Building new semiconductor fabs, new battery plants, and new factories requires enormous amounts of reliable industrial-scale power. It requires new water infrastructure and new rail lines to move raw materials and finished goods. The companies that provide this essential backbone are the silent, indispensable partners in the reindustrialization of America. The fourth and final trend is the data proliferation. The rise of artificial intelligence and cloud computing is creating an almost unbelievable demand for data centers. These massive buildings, filled with tens of thousands of computer servers, are some of the most power-hungry facilities on the planet. A single large data center can consume as much electricity as a small city. This is creating a new and rapidly growing class of customer for electric utilities, driving demand for decades to come. By using this mental model, you can see that investing in boring utilities and infrastructure is not a defensive, backward-looking strategy. It is a profoundly offensive and forward-looking one. It is a way to invest directly in the essential, non-negotiable backbone of every single major economic and technological trend of the 21st century. The path of the 99% commits a final, fatal error in judgment. They consistently ignore the sellers of picks and shovels to speculate on the fortunes of the individual gold miners. This is an old adage, born from the California gold rush of the 1840s. The vast majority of prospectors who rushed to the mountains in search of gold ended up broke and destitute. They risked everything on the tiny chance of striking it rich. But the people who made the real, consistent fortunes were the ones who sold the prospectors their picks, their shovels, their blue jeans, and their food. They profited from the boom without taking on the speculative risk of finding the gold. We see this exact same dynamic play out today. Investors become mesmerized by the gold, the exciting new electric vehicle company that promises to be the next Tesla, or the revolutionary AI software startup that could be the next Google. A frenzy develops. Valuations get stretched to absurd levels. The competition is fierce. For every one Tesla, there were dozens of other EV startups that went bankrupt. For every Google, there are thousands of failed software companies. Speculating on which individual company will win these brutal wars is a low-probability bet. The wise investor, the Buffett-style investor, ignores the gold miners and buys the company that sells the electricity to all of them. The successful EV company needs electricity to power its factories and to charge its cars. The failed EV company needed electricity to power its factories before it went bankrupt. The AI startup needs massive amounts of electricity to run its data centers. The utility that provides that power profits regardless of who wins or loses. It is the ultimate picks and shovels play on all of modern technology. By owning the electrical grid, you have a stake in the success of every new technology that plugs into a wall. You are taking a toll from the entire innovation economy without having to bet on a single risky venture. This systemic error in focus, this obsession with the glamorous gold over the boring but profitable shovels, is one of the primary reasons why so few investors succeed in the long run. By simply inverting this problem, by choosing to own the essential infrastructure that enables all other businesses, you give yourself a structural, almost unfair advantage. We end where we began, with the quiet giant that this philosophy built, Berkshire Hathaway Energy. Its financial statements are the ultimate proof, the direct connection between every principle we have discussed and the creation of staggering wealth. Today, BHE is a corporate colossus. It serves over 12 million customers, owns over $130 billion in assets, and earns well over $4 billion in net income each year. It is one of the largest and most important pillars of the entire Berkshire Hathaway conglomerate. But the most stunning fact about BHE is not its size, but how it has grown. Since Berkshire Hathaway acquired the company back in 1999, Berkshire Hathaway Energy has never, not once, paid a dividend up to its parent company. For over 2 decades, 100% of its earnings have been retained and reinvested back into the business. Every single dollar of profit has been used to upgrade its existing utilities, build new renewable energy projects, and acquire other essential infrastructure assets. It is the compounding machine in its most perfect, undiluted form. This single, simple fact is the most powerful lesson in this entire analysis. Buffett and his team have treated BHE as their ultimate long-term savings account, a place where they can deploy billions of dollars of capital and be virtually guaranteed to earn a fair, predictable return, year after year, decade after decade. They have chosen delayed gratification on a scale that is almost unimaginable. The result is a business that has grown from a $2 billion acquisition into a more than $100 billion enterprise, becoming one of the most valuable utility and infrastructure companies in the world. It is the living embodiment of the fortress of certainty and the compounding machine, working in perfect harmony. It is the final promise, fulfilled. You have just been given the blueprint for the bedrock of a fortune. You have absorbed a system of thought that has been tested and proven over a lifetime of unparalleled success. It is a mental model that trades fleeting excitement for enduring certainty, a philosophy that rejects the noise of speculation in favor of the quiet, methodical hum of the compounding machine. This is not just another investing tip. It is a fundamental shift in perspective, a new lens through which to view the entire world of business and finance. You now understand why the most powerful competitive advantage is not a new technology or a hot brand, but a moat protected by the force of law. But this principle of the regulated moat, as powerful as it is just one pillar in the grand architecture of a successful investing mind. It is the foundation, the bedrock upon which everything else is built. But a foundation alone is not a complete structure. It answers the question, what is a great business? But it doesn't answer the next, equally critical question, what is a great business worth? Knowing how to identify a fortress of certainty is one thing. Knowing the precise moment and the right price at which to buy it is an entirely different skill set. It requires a different, yet deeply connected, mental tool. The video that is now on your screen is the next part of that architecture. It is the bridge between identifying a wonderful asset and paying a sensible price. It is the framework that connects the qualitative art of business analysis with the quantitative discipline of valuation. It's the key that unlocks the door between theory and action. You have proven that you are a serious investor, a member of the small minority, willing to dedicate the time and focus required to master this craft. You have separated yourself from the 99% who chase headlines and hot tips. Do not stop now. The path to true financial freedom is a chain of knowledge, and you have just forged the first crucial link. The next link is waiting for you. Complete the model. Strengthen your arsenal. Click the video.